Tax planning when a spouse dies. That's what we're going to talk about here today, because there's some very specific rules you got to know and got to follow to make sure you're taking advantage of the tax code. So if you like what you see here, we talk a lot about taxes, my friends, a lot about retirement planning. So if you like it, don't forget to subscribe down below at the Heritage Wealth Planning YouTube channel. And then don't forget to hit the bell for notifications, because we do a lot of videos, my friends. All right, so I'm going to give you a real world study of a case I was just working on with a guy and his mom the other day. And we'll go through it. So basically, husband dies in April. Wife is still alive. All right. So and this is 2018. Husband dies April. Wife is still alive. What do they file when she files at the end of December? What will she file for 2018? Well, she'll file married filing jointly still, because in the year of death of one of the spouse, the deceased, you still have the end of the year to be married filing jointly, which is critical. We'll go into that here in just a second. All right, now what happens next year? Next year, she can't, unless she's a qualifying widow, essentially taking care of a child. So basically, no, not basically, literally next year, she will be a single taxpayer. A widow, same thing. Single and widow are the exact same thing. So she'll be a single taxpayer. So we have until 31 December in terms of figure out what we're going to do from tax planning perspective. And unfortunately, her accountant is like, oh, we don't need to do anything. And that's just, nothing could be further from the truth. And I'll show you why. So let's go into this. Let me get my trusty pen here, my calculator. All right, I need my calculator. So in this case, what we have, husband dies in April, all right, and so he was getting $1,700 a month in Social Security, $1,700 a month from January till April. So that's 4 months of Social Security. She was also getting $1,300 a month from January till April. So we have husband Social Security, wife's Social Security. We times that by 4. That's 3,000 times 4. What is that? That'll be $12,000. All right, so we're extrapolating what she will pay in taxes by the end of the year. So figure out if we're going to do anything tax planning by the year end, because again, married filing jointly, it won't happen again for her next year unless she gets remarried. Now, what happens when he dies? She will lose her own Social Security, and she will capture his. All right, so she loses $1,300, but she'll capture his for the rest of the year. So she'll get $1,700 a month for the following 8 months. $1,700 a month for the remaining 8 months of the year, which would be $13,600. All right. Now she also has, because she worked for the city, she also has a pension of $2,000 a month. So that'd be $24,000. I got to get a mic. I had a mic, but it wasn't working, so I got to get a new one. So I got to make sure I'm talking to the camera so y'all can hear me. $24,000 in pension. So her total income, when she files, and at the end of the, don't want that. Let's put the dry erase on my shorts here. That wouldn't be good. So her $24,000 plus $13,600 plus $12,000 is her total income. 24 plus 13,600 plus 12,000. So her total income this year is 49,600. And we're just going to TI for total income. All right, so we got 49,600 as her total income. Now remember, what's the first thing we have to do when it comes to filing taxes? We got to figure out how much of the Social Security is subject to income tax by the provisional income. So we go provisional income. And what we do is we take half their Social Security. So we have to calculate up. Let me just put that there. 12,000 plus 13,600, half that's 25,000. That's 25,600. Let me just make sure I get it done right. 25,600 divided by 2. That means half of their Social Security is 12,800. So we take, again, half their Social Security plus all other income. In this case, all she has is a pension. She might have a couple bucks in interest from the bank. We're not going to use that. So we take half the Social Security plus all their income. And we add those two together. we got so the provisional income is $36,800. Again, all you're trying to figure out here is how much of their Social Security is subject to income tax. So married filing jointly. So the first $32,000 of the provisional income is not subject to any income tax whatsoever. The next amount, up to $44,000, half of that is taxable as income. So in this case, they have $4,800 times 50%, which would be $2,400. How do we get that? 36,000 minus 32,000 equals 4,000. Yeah, 4,800. 4,800 in the second band or bend is times by 0.5, $2,400. So their provisional income is $2,400. Okay, that means of her Social Security of 25,600, only 24 is subject to income tax. All right, so let's erase all this stuff. I'm just singing a song while we're racing to keep you guys entertained. All right. All right. So now, let's make sure we dry that off. All right. All right, so now we figure out her provisional income or her Social Security amount that's subject to taxation. I think it's $2,400. We'll just use $2,400. It's so small it doesn't matter. So $2,400 is taxable Social Security, plus her pension, which is $24,000, which equals $26,400. Now, if you've been following my channel, you'll say, $26,400, that's her AGI. That's not her taxable income. So what jumps out at you here, my friends? You ready? Because they're both over 64, they each have a $13,300 standard deduction, which means they have $26,600 of standard deductions, which means they have negative $200 in taxable income. That's exactly what's going on. So she will pay no income tax this year because she has no taxable income. So even though they have, $49,600 or something like that of income, she owes nothing. Now, she also lives in Tennessee, so there's no state income tax in Tennessee. That's how it works. All right, so now, again, remember, next year, she won't be married filing jointly. Next year, she'll be single. So is there anything we should do in order to take advantage of the fact they have no taxable income? And the answer is yes. So watch this. So actually, let me write. We got, oops. All right, so again, we got 26,400 in AGI, negative 2. Minus 200 in taxable income and no taxes due. All right, let's keep rolling here. Just drop my pen over there. All right. So now, there's my pen. All right, so now what we're going to do is we're going to say, okay, what if she converted $25,000? Let's just use $10,000. It's simple. $10,000 to a Roth IRA. She doesn't have a huge amount of money in IRAs and 401ks. She has about $85,000. What if we just converted $10,000? All right, so this is where it comes into be. There we go. So now we're going to add $10,000 to the taxable income. And what we do here is, again, we take our provisional income. We take the $26,400 Social Security, half that, which is $13,200, plus her pension, plus a $10,000 IRA distribution. And that is going to give us an income of $37,200. $47,200 will be her provisional income. All right, so let's keep rolling. So we know married filing jointly, 0 to 32, no taxes at all. 32 to 44 will be 50% of that is tax. So 42 minus 44 minus 32 is 12,000, which still gives us 3,200. No. So here's what's going on. We have 12,000 here, and we got 47,200 minus 44. That's 3,200 here. So 12,000, half of that is $6,000. Now I need my trusty calculator to figure out what 85% of 3,200 is. And that's 2,720. So yeah, good, you can see that. So basically what's going on here is we have 8720 of their Social Security now is subject to income tax. 8720. So keep that in the back of your mind. All right, so now we got to figure out what their taxes is. So we got Social Security, pension, and the IRA distribution. So in this case, we got 34,000 plus 8720. So let me get my trusty calculator again. 34,000 plus 8720. 42,720. 42,720. Is their AGI, 42,720. We subtract the two standard deductions. And will give us taxable income of $16,120. Tax, $1,612. $1,612. So, and what we've done here is we've said before we had no taxes due, but we were thinking about taking some of our IRA money out, which I suggested we might want to do, absolutely, either by distribution or by Roth. In this case, just put into a Roth simply because she doesn't need the income, because she has a pension and the Social Security, which is because she has no debt, is well more than what she needs. But you might as well take advantage of the married filing jointly thing, tax filing, because at the beginning of next year, you don't get any more. So if she were to take $10,000 as a Roth, or even just a distribution out, it would cost her $1,612 in tax. So essentially, even though she's only in the 10% tax bracket, because if you're married filing jointly, and your taxable income is $16,000, you're in a 10% tax bracket. But for a $10,000 distribution, it costs her $1,600 in tax. $1,600 divided by 10,000 is 16%. So 16% tax bracket, tax. 16% tax while in a 10% tax bracket. And that's the nature of Social Security taxation. Again, I talked about this in a previous video, but it's important to know that you're not just paying dollar for dollar on your income tax, it's also raising the tax you pay on Social Security as well. However, watch what happens next. I'll do another video when we just show you the difference between a married filing jointly and a single taxpayer in the same strategy. Because again, her CPA was saying, don't do anything, Miss Sally, because just don't. And you're like, why? So watch, stay tuned. I'll do it next one. So if you like what you see here, don't forget to subscribe down below. And of course, comments, questions, concerns are always welcome. Thumbs up always help me too with the YouTube algorithms, those algorithms. And then of course, don't forget to go to the blog at heritagewealthplanning.com. So stay tuned for the next one. Thanks, guys.